Welcome to Chapter 9, Plant and Intangible Assets. So in this video, we'll just start our discussion regarding what plant assets are and also what intangible assets are. So just plant assets overall, just in general as our overall category, they represent a bundle of future services. So they can be seen as sort of long-term prepaid expenses. So the whole chapter actually is going to look at all kinds of plant assets, and we break them down into these three general categories here. So we have tangible plant assets. So those are the things, if something's tangible, you can touch it. It has physical substance. So this category would include things like buildings, equipment, and land. However, we want to make sure to distinguish depreciable assets like buildings and equipment from land. So we know we depreciate buildings and equipment, but land is one of those assets that aren't depreciated. So tangible plant assets will include depreciable assets, but also non-depreciable assets, which would be land. Now, a second major category of plant assets would be intangible plant assets. So if something is intangible, that means it can't be touched. It doesn't have physical qualities. So these would include assets that are non-current but that lack physical substance. So examples of this would be things like patents, copyrights, trademarks, franchises, and goodwill. And then a third major category of plant assets would be natural resources. So these are things like oil, minerals, and timber that are mined or taken out of a piece of land and then converted into inventory. So those are the three main kinds of plant assets for a company, and we'll be looking at each of these in a little bit more detail later on. So what's important for all plant assets are accountable events, meaning those events that have to actually go on the books. So for plant assets, there are three primary accountable events. So the first one being acquisition. So that's when you acquire or purchase the plant asset. So that's an accountable event that we actually need to journalize and put on the books. Second would be allocation of that asset's cost to expense over the asset's useful life, except land. So this would be depreciating or amortizing, which we'll see in a second for intangible assets, but that's when we depreciate or amortize the asset's cost. And at the end of every period, we have to record that depreciation expense or that amortization expense. So that's something that's accountable that needs to go on the books. And lastly, when we end up selling or disposing of that plant asset, that is also something that needs to be accounted for and recorded on the books with the appropriate journal entries. So there will be several videos for this chapter, but for this one, the first accountable event that we'll look at just for this video is that of acquisition. So acquiring the plant asset. So the cost of a plant asset, that's going to include all of the expenditures, all of the costs that are incurred that are considered reasonable and necessary for getting the asset to the desired location and ready for use. So when we buy a plant asset, it's not just the purchase price that we will include as the overall cost of the asset to go on the books. You first want to determine, okay, what's the purchase price, first of all, and then also what are all the necessary and reasonable expenditures we've so far incurred to not only get that asset ready for use, but to get it to our desired location. All of those costs are added in to come up with the total overall cost of the asset to go on the books. The only thing that won't be included would be interest expense. So interest expense that is incurred by financing the purchase of that asset will not be included in its overall cost. So some things that we will often include in the total cost of a plant asset would be things like sales taxes that we pay on the purchase price, because we know, especially in California, when you get to the register or you get the final invoice of something. It's not, you don't just pay the purchase price, sales taxes are added in. Also delivery costs or cost of installation, all of those are costs that are additional to the purchase price, but that are reasonable and necessary to get that asset ready for use and to the desired location. So we're going to look at an example here. So it says a factory in Mississippi orders a machine from a Colorado tool manufacturer at a list price of $10,000. Payment will be made in 48 monthly installments of $250, so they financed this purchase, which include $2,000 in interest charges overall. Sales taxes of $600 must be paid, as well as freight charges of $1,350. Installation and other setup costs amount to $500. So we want to determine the overall acquisition cost of this asset before we actually put it on the books. So the first thing we start with is the actual purchase price. So the purchase price here we know is $10,000. So that obviously we'll start with. But then we go through this list of expenditures and determine which of these are reasonable and necessary for getting the asset ready for use and to its desired location. So remember, the first thing they mention here is the $2,000 in interest charges. So remember, the $2,000 in interest charges, if you're financing the purchase of something, interest charges are not included as part of the asset's total cost. Instead, that interest will be expensed out as interest expense for the period. So we're not going to add in that $2,000. But sales tax is a reasonable and necessary cost that is incurred to not only get the asset ready, but to get it to the desired location. Because how so? Well, sales tax is not something we can avoid. It's something you are going to have to pay if you are going to purchase this item. So sales tax is one of those things, it's necessary. It's part of life when you make a purchase in a state that charges sales tax. So we're going to add sales tax in here. And the freight charges, those are not only reasonable, but they're also necessary. It's reasonable in the fact that no one's going to be shocked that you have to pay to get something shipped. And second, we kind of have to pay that $1,350 to get the asset to our desired location, because if we don't ship it to where we are, how are we going to be able to use the asset and gain benefit from it? And lastly, we kind of have to install and set the machine up to be able to use it. So if we don't pay those installation fees, the asset can't be ready for use. So these installation fees are reasonable and necessary to get the asset ready for use. So we're going to add the installation costs in there as well. So when we add the $10,000, the $600, the $1,350, and the $500, the total assets cost here comes out to $12,450. So this $12,450 is actually what that machine would be recorded as on the books. So that's the amount that we will see next to machine when that machine is put on the books there. But remember, when you're looking at these lists of costs, interest charges are not included as part of an asset's total cost when we're talking about financing the purchase of an asset. However, just a side note, not that we'll be looking at this, but if you are constructing your own asset, for example, then in that case, any interest involved with that process would be included. But when we're talking about actually purchasing an asset, not constructing your own, interest would not be included. So we just now looked at how we determine the overall cost of an asset that has been purchased, like a piece of equipment or machinery. So we have to include all of those things. But what if the thing that you're purchasing specifically is land? So when land is purchased, we have to include various incidental costs incurred in addition to the purchase price. So like we saw with that piece of machinery, there were some other additional costs we incurred to get that asset ready for use. But with something like land, we all know that it's not just the purchase price that you're going to incur. There's a bunch of incidental costs. So with the purchase of land, some additional costs that you might come across would be things like commissions to your real estate broker, escrow fees, legal fees for examining and insuring the title, any delinquent taxes paid by the purchaser, fees for surveying the property, draining, clearing, and grading the property. So all of those costs at the end of the entire purchase process would be added together, and that total amount is what would be recorded on the books in the land account. Now, land improvements, which means actually making improvements to the land purchase, they are separate. They're kept separate from the actual land that is improved. So land improvements here it says they have limited lives, separate from land. So it's kept in a completely separate account and also subject to depreciation like buildings and equipment. But land itself is not depreciable, but land improvements are. So that's anything that's added to the land to improve it. So if you were to, let's say, add some structures to the land, for example, that would be subject to depreciation, where the land itself, however, is not subject to depreciation. So we have a separate account for land improvements that would be shown on the books. Buildings, they are sometimes purchased with the intent of doing some extra work to them, like remodeling, before putting them to use. So any costs that are incurred to remodel the building before using it, all of those are going to be added into the building's account. However, after that building is officially placed into use, any repairs made to that building would be considered not a cost added to the building's account, but instead would be considered maintenance expense that you expense out in each period. Any work done to the building before you put it into use will go into the building's account as part of the asset's cost. But after the building is put into use, any of those costs incurred for repair and maintenance would be expensed out as repair expense or maintenance expense within the period that it was incurred. And lastly, with equipment, same with the machine we just talked about, so this is same idea. When equipment is purchased, all of the sales taxes, delivery costs, and costs of getting the equipment ready to go are all considered part of the equipment's total cost. So it's not just the purchase price that we add into the account, but all those other necessary costs to get something like a piece of equipment ready to go. So it's important for us to, from a real world perspective, so if a large plant asset, or any plant asset for that matter, is purchased, we have to look at all the costs involved with getting that asset ready for use. So we have to make sure to add all those in before actually recording that asset on the books. So that is that for this video. Continue watching and we'll start talking about the allocation of a lump sum purchase.